Hi, I'm Steve LaFrance with a brief update for February. So much has been happening in the first month of this year, it's not possible to summarize all the news, so my focus will be on the economic and market highlights to get us up to speed on the net effects and the future direction. So here we go. Stocks are trading higher with a shift in market leadership. Large cap value has outperformed large cap growth by over 2.5 percentage points in January. The Dow Jones approached its all-time high from December, while the growth factor, NASDAQ 100, and technology sectors each underperformed the S&P 500. The catalyst? AI-related news from China, which I'll come back to in a moment. The S&P returned 2.7%, slightly outperforming the Russell 2000's 2.5%. Notably, 7 of the 11 S&P 500 sectors outperformed the index, with AI-related news leading to a sell-off in tech. And here's where things gets interesting. The MSCI International Index returned 4.8%, outperforming the S&P 500 due to strength in Europe, while the MSCI Emerging Markets Index returned 2.2%. In January, Chinese startup DeepSeek unveiled an AI model competing with top US models like ChatGPT, but at a fraction of the cost using cheaper, less advanced chips, challenging the view that cutting-edge AI requires significant investment in high-performance hardware. This development led to a sell-off in US tech stocks. NVIDIA's market capitalization dropped by nearly $600 billion, impacting other companies like Microsoft and Alphabet. Note, I'm only referencing these companies because they're part of the so-called Mag 7, which was largely responsible for most of the gains last year, and this recent news caused the S&P to trade lower due to its significant exposure to these AI stocks. On the economic side, Q4 gross domestic product slowed to 2.3% after achieving 3.1% and 3.0% the previous 2 quarters, yet still represents solid economic growth on a historical basis. Consumer confidence fell more than expected with a score of 104.1 versus an expected 105.7. On the other hand, personal income and consumer spending both continued to rise in December, either in line with or exceeding economists' expectations. The various inflation metrics monitored by the Fed have remained stubbornly anchored in the mid to upper 2% range. So, as widely expected, they left rates unchanged at 4.5% after its January meeting. Jerome Powell's post-meeting interview revealed they will cautiously monitor the inflation and employment data and signaled rates may remain where they're at for longer. Looking ahead, the next employment report is due later this week and is expected to show a solid 158,000 jobs created in December, which would be a sign of a continued healthy labor demand and fuels the expectation of the Fed maintaining rates. Stop me if you've heard this before, higher for longer. Their next meeting will be March 18th, so a lot can happen by then. Who knows? That's all for now. Stay the course, take care of yourselves, and thank you for your trust and confidence.